In the U.S., the market has been pretty robust and driven by fiscal stimulus and monetary easing, as well as good rollout from a vaccine standpoint here in the U.S., which has allowed for the economy to reopen quicker than expected. In Europe, the story is a little bit less good. Europe has been challenged in terms of vaccine rollout, as well as the fiscal stimulus measures have not been as significant relative to the U.S. From a dollar size standpoint. So U.S. is in a better position than Europe currently. The biggest differences really are kind of the risk-reward proposition between short duration and longer duration. Short duration, in many ways, is a very risk-averse, almost absolute return-focused strategy, and is very unique, especially on a risk-adjusted basis. Very low volatility, lower drawdowns, no defaults. Longer duration high yield is more of a relative value strategy. It has more market and duration risk, and so there is more volatility in the results. But I think short duration really is a good comparison, or is a good asset class when you compare it to other more risk-averse strategies, whether it be investment grade and the like. Performance there is very compelling on an absolute, relative, and risk-adjusted basis. At Post, when it comes to short duration, high yield, we definitely differentiated in a couple ways. I would say first, we've been managing short duration capital for almost 20 years at this point. So we are, if not the longest tenured manager focused on this part of the high yield market, we're one of the longest tenured managers. I'll also say we manage at Post currently $16.5 billion of AUM, and approximately half of that is in short duration. And so it's a very large strategy for us. And again, that's in comparison to some of our competitors, where this asset class is a much smaller percent of their overall pie, and generally speaking is much lower AUM on an absolute basis as well. I would say where we stand out is our track record. We have, again, over that 19-year period, we've had 0 defaults in the strategy. It's a very defensive strategy focused on capital preservation, loss avoidance, and so we've been able to not have a default since inception of the strategy. And at the same time, in that 19-year period, we've only had 1 negative year of performance. Every other year has been a positive performance in all different types of environments and markets. And it's driven by our philosophy, our process, and our team, which is a very deep bench of analysts and portfolio managers that are focused on this strategy. I think when it comes to short duration, we are in a pretty unique environment. Really, it's kind of a Goldilocks environment for short duration, which is, on one hand, you have the Fed remaining very accommodative, and so, the current expectations are short rates will remain at 0 for the foreseeable future. Let's say the next 12 to 24 months at least. And so that's very positive for short duration credit. At the same time, all the fiscal stimulus, all the reopening trade, and the economy reopening is a very big benefit for fundamentals, which reduces credit risk in our portfolios. And so that's a positive. And then finally, given what we've been seeing around inflation fears and the curve steepening, so the short part of the curve, which is most relevant to short duration high yield, staying at very low levels. At the same time, you've seen a steepening with the 10-year widening pretty meaningfully, into the 160s today. And that has resulted in certain companies deciding to not refinance longer some of their shorter duration bonds because they think that the price doesn't necessarily make sense for them. And so the opportunity for positions to continue to stay outstanding longer and for our portfolios to continue to collect the coupon on those bonds has increased with that steepening of the yield curve. So really, those 3 factors make short duration high yield in a pretty good sweet spot right now.